expert from Ericsson, Steve Waygood, Chief Responsible Investment Officer from Aviva, George Dallas, Policy Director, International Corporate Governance Network, and Carolyn Avan, a Policy Officer at Oxfam France. We will then enjoy closing keynotes from Alberto Carrillo-Pineda from the Science Based Target Initiative and from MEP Heidi Huteler, who is a strong advocate for a number of years on advancing responsible business conduct and corporate governance. It's a brilliant finish. So as a brief introduction to the topic today, at CDSB, we see non-financial reporting as a key element of success to make business more transparent and ensure they consider environmental and social risks and opportunities in their daily business activities. Last week, I can't believe this, I celebrated 10 years working for CDSB, and I've seen the evolution of non-financial reporting globally across this period, and I believe the times we're living in are definitely exceptional. We've never seen more momentum and alignment between regulators, supervisors, investors, businesses, standard setters, and other civil society organizations on what needs to be done to build back from the COVID pandemic and associated economic challenges, with a response that addresses and is driven by the challenges presented by climate and biodiversity. 2020 was certainly a year that will stay in history, and I believe 2021 will also be a turning point on these issues as we're heading to COP26 climate talks and the COP15 Convention on Biological Diversity. As well as last week, the IFRS Foundation announced their plan to respond to a broader demand for global sustainability standards. And here in Europe, we'll see the EU present the new Sustainable Finance Strategy and a review of the Non-Financial Reporting Directive. Every one of us, every stakeholder needs to play a role in driving changes towards the common objectives to protect the people and planet as we head towards 2030, where certain climate targets need to be met. It is also the deadline to achieve the Sustainable Development Goals. This is why discussions like the one we're having today on the objectives and the best way to achieve them are absolutely critical. Reflecting on non-financial reporting and corporate governance, the EU want to be as ambitious and play as a key leading role. We are expecting the review of the Non-Financial Reporting Directive with a higher level of ambition and granularity to ensure it becomes fit for purpose, coupled with the development of the EU non-financial reporting standards. These standards would need to be built on existing standards, as there's no need to choose between existing standards used by global businesses and the development of the EU standards answering specific EU needs. The EU may want to go faster and ensure the standards reflect specific requirements introduced by various sustainable finance legislations, including the taxonomy regulation. Well, ladies and gentlemen, we cannot miss the opportunity ahead of us to ensure that businesses have the relevant tools, incentives, and frameworks to guide their activities and decision-making towards pathways that are aligned with the low carbon and sustainable economy. That is why at CDSB, we're calling for an ambitious review of the Non-Financial Reporting Directive, ensuring that the information is of enough quality, consistency, and comparability, as well as accessible in the annual reports of businesses for various users of non-financial information. We also believe that a reasonable scope should be chosen for the directive beyond the current scope, and it needs to be aligned with the recommendations of the TCFD and ensure connectivity between financial and non-financial information. These changes in the shape of corporate reporting will have implications for the governance of businesses, with the board setting the tone at the top on how companies manage environmental and social issues, ensuring they are factored into strategies, risk management, remuneration, and governance processes, amongst others. I look forward to the discussions today to see how corporate governance can be further improved and reflected within corporate reporting. So without further ado, it's enough from me. I am extremely grateful to hand over to the European Commissioner for Justice, Didier Reynders, to present some of the current thinking at the European Commission and what companies can expect in the coming months. Commissioner, the floor is yours.
Good morning, ladies and gentlemen. I would like to thank the organizers for inviting me to kick off today's event. The Climate Disclosure Standards Board and the Alliance for Corporate Transparency come from the world of corporate public reporting. This is closely linked to corporate governance, for which I'm responsible as Commissioner for Justice. The Non-Financial Reporting Directive was an important first attempt to drive our companies towards sustainable behavior. But we have seen that reporting obligations have not made the breakthrough. Evidence, including the assessment of the Alliance for Corporate Transparency, shows that companies do not publish comprehensive information on how they address sustainability matters. Further evidence shows that short-term prevents corporate leaders from focusing on the long-term success of their companies and from devoting the necessary attention to sustainability issues. We are facing a sustainability crisis of an unprecedented scale and urgency. We also have the challenge of ensuring a sustainable recovery from the COVID-19 crisis. In these circumstances, we should do our utmost to ensure that all companies can contribute to this broader sustainable recovery. We have to take complementary action to improve not only corporate reporting, but also the corporate governance framework. The two upcoming Commission initiatives would strengthen these areas in a way that they reinforce each other. Underpinning non-financial reporting obligations with legally binding duties would result in improved and more reliable reports. On the other hand, improved non-financial reports should enable stakeholders to monitor and enforce compliance with the corporate and directors' duties. I have no doubts that sustainable corporate governance is a win-win for business and society. Environmental degradation and climate change are creating risks to business and their supply chains. The transition creates big opportunities. Companies that are ahead in the game will benefit most. I shall now elaborate on my ideas for our legislative proposal. The proposal would take a holistic approach where directors' duties underpin a corporate due diligence obligation. First, we aim to clarify the director's duty to act in the best interest of the company. In the last 30 years, corporate decisions focus more and more on generating short-term profit to shareholders. The requirement clarifying that directors should consider both the long-term interest of the company and the interest of main stakeholders will enable directors to take a longer-term perspective. They will be able to incorporate sustainability aspects in their decisions. Such a change would remove an obstacle to investment, innovation, and creation of long-term value. All of this is necessary to accomplish the sustainability transition. It is important that directors also have a clear obligation to identify sustainability risks and opportunities and to integrate these in the corporate strategy. Directors would also need to set science-based and measurable sustainability targets. They would need to set also a trajectory or transition plan to reach those targets. They will also need to ensure that such a strategy is implemented with the necessary risk assessments and due diligence procedures. We want to ensure that corporate decision-making changes to a sustainability mindset at all levels. We are also assessing how to ensure best that directors make informed strategic decisions on the various sustainability-related matters. Requiring directors to consult main stakeholders is a possible way forward. The requirements I mentioned would serve the best interest of companies and improve the sustainability, competitiveness, and resilience of the EU economy. At the same time, we have to be more ambitious. We need to make sure that companies effectively contribute to reaching our overall sustainability objectives and align their activities to those. We are therefore considering requiring sustainability targets that are aligned with our overall climate neutrality and other environmental objectives. These targets should also take into account the impact of the company through its supply chains. This brings me to the second pillar of our initiative, the corporate due diligence obligation. We would establish an horizontal obligation for companies to identify and mitigate their potential adverse impacts throughout their value chains. Such impacts include climate-related and other environmental harm, human rights, health, and social impacts. Due diligence is a context and risk-based approach. It includes prioritizing based on an assessment of the significance of the adverse impact. The results of this assessment can also feed into decisions on what information is disclosed under the Non-Financial Reporting Directive. We are exploring how to enforce best the forementioned corporate and directors' duties, including by relying on civil liability regimes and/or assigning a role to selected public authorities. Finally, our preparatory work also covers the directors' incentives that are enshrined in remuneration schemes. We are assessing the need to ensure that those incentives are aligned with the sustainability-related elements of the company's strategy. All aspects of the Sustainable Corporate Governance initiatives are subject to our open public consultation that was open until yesterday. We registered a huge participation to the consultation. The feedback of the stakeholders will be very important to inform the political decision of the College on the proposal. The plan is to submit a legislative proposal to the EU co-legislators by June. Thank you, and I wish you fruitful discussions.
Well, thank you very much to Commissioner Reynders for opening our webinar. I'm Richard Howard, and on behalf of the Frank Bold team, you're very welcome. Thank you to Mardi and our CDSB colleagues. We'll be hearing more from you later. And just a reminder that although there are so many people on this webinar, we can't answer each of your questions. Please do put comments and responses in the chat, and they will be reviewed afterwards and be part of what we produce. We're now moving on to the keynote from our academic speaker this morning, and that's Professor Andrew Johnston from the University of Warwick. Andrew works on studies on areas of company law and of corporate governance and financial markets. He's a close follower of EU developments, having experience at the University of Warsaw and at the European Institute in Florence. He's a member of the Good Corp Research Network based in Brussels. He coordinated the Corporate Governance for Sustainability statement that I think is one of the most authoritative references in the area of sustainable corporate governance, was published by the Harvard Law School and included leading academics from France, Spain, Sweden, and the Netherlands. Andrew, how can board responsibilities and directors' duties be redefined? And as the Commissioner has just told us, why is it insufficient to rely on information disclosure and non-financial reporting alone? Good morning.
Thanks for the kind introduction, Richard, and hello to everybody wherever you are. I think it's evident that the economy is not sustainable and that climate change poses an existential threat to humanity, and that companies and value chains produce a wide range of adverse impacts on human rights and on other interests. It's also clear that many investors recognize that unsustainability, whether that's environmental, social, or governance, creates significant financial risks for companies, and they want companies to address these risks. Many companies also want to take part in the transition to sustainability, but there's still little sign that that's happening. So that's the context in which I worked with Frank Bold and around 80 other company law scholars to produce the statement on corporate governance for sustainability. And we were trying to find a way out of the current impasse. The aim was to suggest a way forward that was compatible with what the Commission was discussing in its Sustainable Corporate Governance Initiative, which closed yesterday. So we started from the point that the directors already have wide discretion available to them in law to take account of adverse impacts on the environment, adverse impacts on human rights and beyond, when they take decisions on behalf of the company. So that discretion is already there in company law in the legal systems of all of the member states. But a variety of pressures from outside of company law, what we might talk about as wider corporate governance, means that directors and managers are not using their existing discretion to make sustainability a corporate priority. And so sustainability generally remains little more than good words in CSR documents. So our conclusion is that making changes to the law, either to clarify that the directors are permitted to consider sustainability, or merely requiring them to have regard to sustainability or the company's long-term interest, in itself will be ineffective. So what contribution can the law make? As a way of achieving the goals of the Commission's initiative, we suggested procedural law designed to steer corporate boards toward integrating sustainability into strategies and decision-making of the company without making boards and managers unaccountable. Procedural obligations don't mandate outcomes. They just require a process to be followed with the aim of making it more likely that sustainability will be integrated into the company's decisions. In this situation, they will put the board in charge of corporate sustainability and the way the company addresses related impacts and risks. So our proposals also complement civil society pressure for and national legislation requiring companies to carry out due diligence, and they should be complemented by an EU-wide sustainability due diligence obligation. So on to the next slide. Slightly belatedly, what are our proposals? Well, we propose that the board should have a duty to ensure that the company develops, on the basis of its due diligence process, a forward-looking sustainability strategy that identifies significant and salient sustainability risks and severe impacts connected to the company's business model, operations, and value chain. The board should set out verifiable targets for preventing or mitigating the risks and impacts, and should commit to making resources available to achieve this. Second limb of the duty would be for the board to monitor ongoing implementation of the sustainability strategy. And the third limb would be that they should report and sign off on implementation of that strategy on an annual basis in the company's non-financial report. This would link with the non-financial reporting directive. Now, three main questions have been raised in relation to the proposal that we made at the beginning of last year. Moving on to the next slide. The first question is, why should we rely on corporate governance to promote sustainability? Well, as most of you know, the conventional argument about corporate governance over the last 30 years has been that directors and managers should focus on creating value for shareholders. Now, our proposals are compatible with that, but we emphasize that shareholder value can be created in an enlightened, sustainable way that seeks to identify and minimize impacts, or it can be created in an unenlightened way that externalizes costs onto society and the environment. What's the choice between these two options? Well, that choice depends on regulation, it depends on market forces, it depends on dialogue between shareholders, directors, and managers, as well as on the wider corporate governance system, which constrains and shapes how managers exercise their discretion, and generally seeks to ensure that directors hold managers accountable to shareholders. So what's been done about sustainability to date? Conventionally, the argument was that we should use instrumental regulation, that's labour law, environmental law, or we should use taxation to ensure that companies bear the costs of their activity. And this leaves companies free to focus on shareholder value. But over recent years, it's become increasingly clear how difficult it is to use instrumental regulation to force companies to internalize their costs. Environmental, human rights, and other impacts may arise from the operation of subsidiaries and value chains near and far. Regulators do not have full knowledge of costs and benefits. This makes it impossible for regulators to address complex problems like climate change because they cannot direct wholesale transformation of companies' business models. This problem with instrumental regulation has led regulators and other governance initiatives to rely increasingly heavily on information disclosure, requiring companies to inform shareholders, potential investors, consumers, and other affected groups about company activities, with the aim that the information disclosure will harness market forces and put pressure on companies to address their costs. Now, we've seen an explosion of corporate social responsibility initiatives from companies, but these have often been disconnected from corporate strategies, and their effect has been limited in terms of controlling the externalities or social costs that are connected to companies' business models and that arise from global supply chains. At the same time, we can note innovative and important developments in relation to information disclosure. I'm thinking of the recommendations of the Task Force on Climate-Related Financial Disclosures. I'm thinking of the Non-Financial Reporting Directive. But the pace of change is too slow. There's a lack of relevance, reliability, and comparability. And there's no indication that market forces are going to solve this problem in time. So that means we need to consider a third option, relying on the corporate governance system. Our proposal is to impose clear procedural obligations on the board, requiring them to take into account the findings of the due diligence process, to use their existing discretion in law to integrate sustainability by ensuring that a strategy to prevent or mitigate adverse impacts is drawn up, implemented, and monitored. The EU has the opportunity now to take decisive action and steer those companies operating out of its jurisdiction towards greater sustainability throughout their operations. The sustainability strategy obligations we recommend should be adopted alongside and as an essential complement to mandatory sustainability due diligence, so there is certainty and a clear roadmap for companies and their boards. Whether modelled on the French approach or another approach appropriate for the EU context, companies should carry out vigilance or due diligence and respond appropriately. But it's for those at the very top of the company, that is the board, to ensure that this process occurs, rather than allowing it to be delegated downwards to a subordinate group of managers and given a correspondingly lower priority. So this two-pronged approach of due diligence and directors' duties will mutually reinforce each other. They will help to achieve the goals of the Non-Financial Reporting Directive, the Sustainable Finance Initiative, and others. The two-pronged approach is going to be more effective and less intrusive than major changes to regulation. Directors have better information about the impacts. The corporate and financial risks of unsustainability will be identified and mitigated on an ongoing basis. And decisions at the level of the parent company board can cascade down through the group and the supply chain without regard to borders or jurisdiction. The two-pronged approach is going to be more effective than disclosure alone because it relies on the board's command and control of the company. Indeed, this approach will provide the basis for more relevant and more reliable information disclosure in the future. Okay, my second question is whether our proposals would reduce managerial accountability.
1 minute, please, Andrew.
So our proposals rely on procedural regulation working with the existing logic of corporate governance, existing mechanisms of accountability. Our proposals do not require directors to balance the competing interests at stake. A broad obligation to balance would not be justiciable, so would reduce accountability to shareholders without increasing accountability to others. And so moving on swiftly then to the third question, why rely on directors' duties? I've already noted we don't need to reform directors' duties because their discretion is already broad and they're extremely unlikely to face liability for short-term or long-term decisions. The question is how we can steer directors towards using their discretion to integrate sustainability. Simple encouragement will not suffice. Obligations are needed. How would these obligations be enforced? In practice, it would only rarely be needed, but where necessary, they could be enforced using directors' duties, a pre-existing mechanism allowing actions to be brought in the name of the company against directors who take decisions that harm the company. Deliberate failure would be a breach of the duty of good faith or breach of the intérêt social. Accidental failure could be breach of the duty of care. But we would need a couple of further measures to complement this approach. We would require management incentives to be linked to KPIs identified in the strategy, linking with the Shareholder Rights Directive. And we would suggest a non-executive board level committee to monitor and review content and implementation of the strategy. that would link with the general policy of relying on non-executive directors, or we would suggest that another way be found that ensures relevant expertise is available to the board. So to conclude, companies, shareholders and wider society want business to contribute to a sustainable future. And the time has come to introduce board-level procedures that complement due diligence processes and harness the power of corporate governance to make sustainability a reality. The final slide includes a link to the paper that I wrote with the other company law scholars. Thanks for your attention today. Thanks to you, Richard, and back to you.
Thank you for cramming so much into a 10-minute presentation, and I'm sure many people will want to follow up that paper. The slides, together with the recording, will be made available to everyone afterwards. So can I now invite Theo Jekyll from Ericsson, Caroline Avant from Oxfam France, George Dallas is delayed, but we hope will still join us, and Steve Waygood, another good friend from Aviva Global Investors, to put your cameras and your microphones on. They will form the panel which will now respond to what we've heard from both Commissioner Reynders and from Professor Johnston. And a reminder, please do put your own responses and comments in the chat function as we go along. Now, first, Theo Jekyll, he's corporate responsibility expert for Ericsson, legal counsel responsible for human rights in the company and in its value chain. In previous roles, he's undertaken corporate investigations globally in South Asia and in Africa. So he has a global as well as a European focus. And Theo, I heard you at the UN Annual Forum on Business and Human Rights last November say that you thought there was now a company consensus that there should be legislation on mandatory due diligence, human rights and environmental due diligence by companies. Why is that true for Ericsson and for your board?
Thank you, Richard, and thank you for giving me the opportunity to speak here today. So let's to your question, the consensus around companies and why that's important for us in Ericsson. So Ericsson quite early on last year supported a public statement in support of the Commission's work on mandatory human rights and environmental due diligence. And the reason for doing this is that we see a need for harmonization, alignment, and legal clarity on these issues. And as has been raised before by the previous speakers, we also see that the current regime, where most of the legal requirements on companies are merely focused on disclosure, is not sufficient. So the disclosure requirements, including the non-financial reporting directive, target in a way the last step of a proper due diligence, and in some ways do not properly address the steps that need to be taken before proper disclosure. You need the identification of risk, the management of the risk, the follow-up, and so on. And that's where we see the current proposal on mandatory human rights and environmental due diligence to be an important next step in complementing existing legislation on disclosure. And just to speak more from Ericsson's current approach and perspective and the involvement of our board and management, I would also like to stress that board and management oversight and involvement in these issues is a crucial part of embedding due diligence requirements. So it's important here to stress that due diligence is not a standalone process where it's only about identifying risks and then leaving it at that. If you don't implement it into company strategies, into board oversight, accountability structures, target setting, and so on, then you have not fulfilled your due diligence obligations under international standards, such as the UN Guiding Principles or OECD frameworks. And that's the approach that we currently have, where we the targets that we set at a group level, including environmental and human rights targets, are approved by management and by the board. Their results are reported back to the board on a regular basis. and therefore something that we see as important to be reflected in this legislation as well. Also, as I said, one of the main reasons why we support this legislation is to have the harmonization and legal clarity on these issues. So we see the mandatory human rights due diligence requirements to be a part of informing what companies need to report under the non-financial reporting directive. So as has been said by previous speakers as well, that, I mean, currently we have the requirement to disclose certain information, but there is no clear harmonization on what should inform that disclosure. And that's why we think that it's important to build these requirements on existing standards, such as the UN Guiding Principles. These additional mandatory requirements would then further inform companies' decision-making and target setting and strategies. So I think it's very important to include this perspective of stakeholder engagement, target setting and strategies in the due diligence requirements, not see the due diligence requirements as a separate requirement for companies. As is the case with many other requirements for us as companies. If we take the analogy with GDPR, for example, or other requirements, those requirements also feed into board decisions, target setting, and strategies. And that's how we see the due diligence requirements to feed into that work as well. Just to kind of wrap up here, I would say that the components of an effective due diligence, as I said in my opening remarks, to just clarify that I think when looking at this new legislation, it is extremely important that we don't see due diligence requirements as a tick box standalone exercise. But effective due diligence includes stakeholder engagement, target setting, strategies, board oversight, and so on. And this needs to be reflected in the due diligence requirements that companies have. And by building on existing frameworks such as UN Guiding Principles, I think that we will reflect those requirements, and by saying that companies need to address due diligence in this way. The position that we have currently is that we think that this is going to be effectively addressed by including due diligence requirements, but also aligning the non-financial reporting directive requirements with the due diligence requirements to clarify what it is that companies need to actually report on, what effective due diligence is, and how targets are set in line with those due diligence requirements. So I think I'll hand over back to you, Richard, there. Thank you.
Thank you. Your point about stakeholder consultation was one that the Commissioner said in his address they're really thinking about, but it's only a possibility. So that was a clear message from you there. The next panelist that I'm going to choose is Steve Waygood. Steve is Head of ESG Investment for Aviva Global Investors. They have about 350 billion of assets under management, which he controls. But I think for me, even more important, he's been one of the leading voices in all the actions on sustainable finance in both Europe and globally. He was a member of the high-level expert group on sustainable finance in Europe and a member of the task force on climate-related financial disclosure. He's also been an expert for the European Commission on Corporate Governance. So I think an excellent person to address us today. Steve, what's the investor view on what board responsibilities should be in relation to sustainability? And what's your own perspective of what are the obstacles and the problems that are stopping that happening today?
Richard, thank you very much indeed for the opportunity to be with you. It's a great pleasure. Nobody deserves more credit than you for the non-financial reporting directive. I remember very, very vividly all the work that you did to lead its creation. So very, very kind thanks for your introduction to me, but I think you were far too generous. It's mainly you. I joined from Aviva. We were created in 1696. We have businesses across Europe, in Poland, in Italy, and France. And as Richard said, in euros, we're running approaching $500 billion €500 billion in assets under management. Now we want to be vividly clear that we think that the proposals from the Commission are welcome. We think the idea of a transition plan towards a more sustainable future is correct. The need for science-based targets is also right. Those targets themselves, if you look at the Science-Based Targets Initiative, there's a lot of work that's been done in the last decade to set out what that means, but they are continuing to strengthen and improve. But I think time has come to now embed those in a framework. And the mandatory due diligence proposals are also absolutely right. So I'd like to start by commending Theo and Ericsson for their very constructive approach to this discussion. And we are in broad support of the points that they made. Commissioner Reynders was also clear that there's a sustainability crisis, and we had from Professor Johnston clarity that that represents an existential crisis, and it does. And I'd like to underscore that from the perspective of one of the world's largest insurers, we're deeply concerned that towards the end of this century, the climate crisis and broader sustainability considerations will present an existential crisis to our sector, not just our business. So we're concerned and engaged in this process, not because we're particularly concerned about the pandas or the polar bears, although I am. We're much more concerned about the implications for long-term shareholder value creation. And a lot of the argument about whether this is necessary, whether this whole corporate governance framework is necessary, rests on the question of whether or not there's short-termism in the market. I want to argue very strongly that there is indeed a tragedy of horizon, as Mark Carney set out, and that short-termism comes from a number of perspectives, a number of places, principally the way valuation is conducted in the global financial markets. For those of you that aren't aware, a discount cash flow analysis, the standard way it works, is to forecast out cash flows maybe as many as 5 years, but conventionally 3 years, and then assume the business that you're valuing, the security that you're valuing, will continue to grow in perpetuity at a mean growth rate of about 2%. Now, the fact that analysts only look out 3 to 5 years when doing most of the modeling hard work shows you what they're most concerned about, which is the next quarter and the next year, not the next decade, or certainly to the end of the century. And for a business like ours that's been around for 325 years, the valuation approach assumes away the sustainability challenges that we currently have. Secondly, we have a series of contracts and performance measurement criteria within financial markets, starting from the asset owners through investment consultants, invoked also in fund managers. In fact, if you position yourself for a second, if you imagine what it's like being a fund manager, they're one of the very few industries where you can touch a button and you can see at any second of any minute of any day how that individual is performing against their peer group. There aren't many other sectors like that. And the pressure that conveys upon the individual to perform is certainly not trivial. So we have contracts, we have performance management concerns, there are valuation methodologies, and there's also the culture of finance, where individuals, even at the very top of listed businesses, can be there for a matter of perhaps half a dozen years at best. So this leads to a market myopia. So I want to underscore that we welcome the proposals from the Commission, that we think that this consideration for mandatory due diligence is correct. I want to echo what was said by Professor Johnston, but I want to just bring in 2 notes of caution, if I may, Richard. The first is I don't think we can rely on corporate governance alone to create sustainable markets. And I think the case may have been slightly overstated, but only slightly. Corporate governance, in my view, is the system by which companies are directed and controlled. It involves the board setting strategy, ensuring that that is profitable. It also ensures the board setting a series of values and policies and ensuring that they're understood and well met alongside business purpose. That is, of course, a huge opportunity here, and one I think the Commission and Frank Bold are right to ensure we do the most with that opportunity to shape long-term sustainable markets. But it isn't the job of the board to correct market failures. It isn't the job of the board to, in the economic jargon, internalize externalities. That is the role of government and regulators and policymakers. And that is why it is so important that we see this initiative in its broader context in two ways. First, within finance. I think it is time to have a look at this very welcome raft of initiatives that have come from the high-level expert group, the Sustainable Finance Action Plan. Of course, there's a new plan under development. I think we need to make sure that from a disclosure perspective, we start with the end investor in mind and broader stakeholders, and we work backwards through a system that's connected. From my perspective, that means know your customer regulation needs to be clear. What is it that advisors need to show beneficiaries? That means that the MiFID II, the Market and Financial Instruments Directive, needs to clearly state what we as fund managers need to give the intermediaries. That means the Sustainable Finance Disclosure Regulation needs to be consistent with what the end beneficiary needs. And that means the Non-Financial Reporting Directive needs to make sure we get the data as fund managers we then need to give the intermediaries that then give the customers. And that means the taxonomy, which of course is subject to other debates elsewhere, but the taxonomy is complete and sets a picture that companies can disclose. And I'm missing that systemic vision of how the financial disclosure requirements all fit together, point one. And point two, and my closing point, Richard, the real economy, what drives sustainability most is when the prices in the real economy reflect their full prices to society and the environment. That means internalizing the externalities. That means looking at real economy sectors like oil and gas, like energy, like autos, like chemicals, and ensuring that they pay in their cash flows the cost of cleanup, and that therefore the full cost of capital fully reflects the full cost of carbon on society or the full emissions. That cannot be done through corporate governance. Boards cannot simply decide to internalize their externalities and maintain a level playing field and a broadly profitable business environment. So I think it's time for a new vision of how the emissions trading scheme, the common agricultural policy, the common fisheries policy, the extended producer responsibility, suite of directives and so on. How do those directives come together in the real economy to shape prices so that the cash flows of the businesses that are being valued properly reflect their full cost to society and the environment? So I'm trying to position, Richard, this initiative in its rightful broader context and simply remind us all that we need to have a vision of how all of this fits together whilst fully welcoming this proposal. Back to you, Richard.
Well, thanks very much, Steve. Thank you for the kind words about me, but I'd be the first to say the non-financial reporting directive was good for its time, but needs reform. And I think we've heard from you there that the underpin to this webinar, which is that there must be policy coherence between the proposals on sustainability, sustainable corporate governance and non-financial reporting. You say that should go further, and there must be coherence with a whole set of other areas of European action. And I'm sure that call will have been heard. Now, can I invite Caroline to join us? Caroline Avon is Advocacy Officer for Oxfam in France. She works on extractive industries, tax justice and inequalities. She's someone I read who'd been both a humanitarian worker and a financial auditor. So I think you're a really good person to address us this morning. Would you like to address us on what the civil society NGO community, the Alliance, say about the points in this webinar?
Thank you very much for having me this morning and for organizing this webinar on those very important topics. I want to start with a number of reports that Oxfam has published in recent years in different jurisdictions. So in a report in France, we have found that French companies have distributed on average 71% of their net earnings in dividends and share buybacks. We also found in recent years that the top 59 most profitable companies in the world had distributed on average 83% of their net earnings. And our findings were actually echoed by those of the study on sustainable corporate governance and directors' duties that was commissioned by the European Commission. So, I'm giving you those figures just to illustrate how they illustrate the deep financiarizations of our economies. But of course, this is not without consequences. We know that corporations facing market pressure to focus on financial returns may have been doing so to the detriment of sufficient investments, and specifically into the energy transition. We also note at Oxfam that this pressure is also felt, further down the supply chain, as other Oxfam studies have shown, where living wages at times for smaller contractors remain unattained. So, what we note is that this state of affairs creates a sort of a tunnel vision in which companies fail to integrate and fully embed into their corporate strategies the long-term impact of their activities, which in turn we know can very well be detrimental to their own business. However, we know that the role of the private sector will be actually absolutely crucial in achieving the objectives set by the Union in its Green Deal. So just to give an example, in 2019, a report by CDP pointed out that to achieve net zero emissions, you actually need green capital investment by companies in the EU to double. So, what we note here is that we have a situation in which many actually stand to lose. And I think this was also noted by previous speakers. So I want to also touch on the reforms that have been carried out in France in recent years. In 2017 was voted the law on the duty of vigilance, which is inspiring the due diligence approach as well. And in 2019, the redefinition of corporate interests was extended to include societal and environmental considerations. So first of all, I wish to clarify that in our view, it's imperative to distinguish between, and this was also noted by Andrew Johnston, to distinguish between the due diligence duty, or in its French version, the duty of vigilance, that the company has to respect human rights and the environment, and the duty of care that directors have to the company itself. So now, what can be said of the reforms in France is that, and as many in civil society have pointed out, there has been a lack of interconnectivity between the two processes, and that it actually still remains to be discussed how this apparent extension of the notion of corporate interest could actually be enforced in a practical manner, and how it actually did relate to the due diligence law. So as such, this redefinition of the corporate interest as it stands now is relatively toothless and, frankly speaking, a bit cosmetic, as responsibilities were not clearly outlined. And at times, this has led to the duty of vigilance law being interpreted by some companies as merely a reporting or compliance exercise and not really responding to substantial obligations. So we believe that among other aspects, that's probably not the only one, but we believe that governance processes are indeed essential to ensure that there is greater coherence among all those different initiatives, and to ensure alignment between business models and objectives that are derived from the due diligence and the double materiality approach as per the non-financial reporting directive. So in this regard, and in order to really foster that level of coherence, we think it's essential that the upcoming directive clarifies that directors' duty of care should provide that boards must ensure that the company implements a robust due diligence and double materiality determination process to identify and address severe impacts to people and the planet that are linked to the company's business model. So it's important here as well to note that some of those impacts may have financial impacts on the company, but some may not. And those are also important to take into account. Secondly, that from those processes, the results are integrated into a strategy and clear targets that are designed to effectively address the identified impacts. And so with regard to targets, and given what also have outlined before on the Green Deal, but also this was also highlighted by the resolution adopted by the European Parliament last December. There is a clear need to ensure that we all use, in a way, the same compass model here, and that this materializes through companies adopting emissions targets that are compatible with the Paris Agreement as well. And I was really pleased to hear the Commissioner mention transition plans and trajectory, intermediary objectives, that are very important to also report on actual progresses. Today, we know that less than 15% of EU companies have and disclose Paris-aligned climate objectives. We also think that it's important that boards must ensure that the company retains sufficient resources and financial means to deliver on those targets. And this may require, at times, some changes to the way in which profits are allocated. Special attention needs to be given to matters that can potentially materialize into negative impacts at a later stage, or that are maybe very complex in addressing and will entail potentially a redirection of the business model. So one example of that is addressing the issue of living wages in supply chain. So of course, and one point that I want to mention as well on this is that sustainability expertise among board members will be absolutely key here. There is a need to diversify points of view and include specific expertise in social, environmental, and human rights matter to really drive those processes. Beyond that, we also need to hear the voices of those that are affected that must partake in the elaboration of the due diligence, and this was also noted by the Commissioner. Among them, we note that employees play a unique role, and their representation in boards is also a key aspect here. And so finally, and I will stop there, there are also other legitimate concerns in our view that raise questions. A too great alignment between executive remunerations and short-term financial performance can have detrimental effects to the actual implementation of the company's sustainability strategy. And this is also a matter of coherence in the end. And in the same vein, we have questioned at Oxfam the widening of wage gaps in large companies. Now it stands, this is what we have shown in one of our reports, it stands at 110 between the CEO compensation and their average worker's salary. This is here what we think is an issue of social cohesion that is also important to look at. And I will stop there. Back to you, Richard.
Well, thank you, Caroline. And you made really important points there about how board and executive remuneration is a key part of this. I'll try and come back to that later if we have time. I believe the technical difficulties that were keeping George from joining us have been overcome. So George Dallas, are you with us? Can I just check, put your screen and microphone on if you are there? I'm hoping that you will appear. And if not, we will go into the rest of the panel. And I do apologise if there have been some technical difficulties that.
Hi. Hello, Richard.
George is an old friend of mine. He's policy director at the International Corporate Governance Network. He's got good European credentials as well. He wrote a study on European Union corporate governance policy on behalf of the CFA Institute. He was chief a long time ago, but he was chief executive of Standard & Poor's European credit rating operations, and he's a member of the European Corporate Governance Institute. In the webinar this morning, we've heard a lot about the need for board oversight. Could you comment why it's that important and what that means in practice?
Thank you, Richard, and greetings, everybody, and apologies for being late. I missed what's gone on so far, so I hope I don't cover ground that's been covered. For those of you who don't know ICGN, we International Corporate Governance Network, we're an association representing largely investors, but basically the community of professionals interested in corporate governance and stewardship. Institutional investors are key focus in our investor members. So we have 41 members globally whose assets under management represent $54 trillion. So a lot of the substantial members of the investment community are ICGN members. And we have two fundamental objectives. Firstly, to try to improve corporate governance in companies that we invest in, on the one hand, and then the other dimension is more internalized, focusing on our sector and our industry in terms of being responsible investors and good stewards of capital. So those are our two founding ambitions, and our first policy priority in this context, which fits very much, I think, into this theme, is to promote long-term investment perspectives to support sustainable value creation. Of the 54 trillion that our membership represents, I'd say around 2/3 would be pension money, and some either owned by asset owners or managed on behalf of asset owners. So the long-term focus is fundamental, and certainly that's I think a key area that's been under consideration and under scrutiny in Europe. We are big proponents of trying to promote sustainability in corporate governance. The governance of sustainability is how we put it, because this is a governance issue, and this is something that we do prioritize. We're in the midst of updating our own global governance principles, and you'll see as this becomes public that there's a big emphasis on precisely the themes of trying to have boards become understanding of their, not only how ESG factors impact them, but on how their company impacts society in a broader context, thinking of the double materiality dimension, getting boards in a position to understand these issues and to govern appropriately. And this in turn, I think, leads into the need for good information and metrics to guide both executives, guide board directors, as well as give investors clues in terms of where opportunities and risks might lie. I would like to say something quickly about the European consultation that's just concluded. We've submitted our own submission to that, which you'll be able to see that today. We're putting this on our website, and we're very supportive of where the EU is trying to go in terms of promoting long-term perspectives and sustainability in companies and in the governance process. Our concern is less the objective than maybe the means of getting there, and to try to prescribe much of this in a legalistic context is, I think, something that we're very cautious about. So prescribing particular activities they're the types of issues that we would support, but we're hesitant about certain aspects becoming hard law. And we do think, though, that disclosure is the answer, it should be the driving answer. And on that basis, we certainly are hoping to see that the efforts to build sustainability in terms of how boards operate, being reflected in how companies manage themselves and how they report themselves, both with regard to obviously financial reporting and financial information. But Richard, I know the integrated reporting is very close to your heart, as it is to ours. And we're also, maybe this is a subject we could circle back to if there's interest in it. But I mean, clearly the current debate, and not only about the European Sustainable Corporate Governance Initiative is drawing our attention, but I think a parallel development looking at how the non-financial or sustainability reporting standards are starting to come together is also fundamental. And that's something that we think is key, not just in Europe, but really in a global context. So I guess to summarize, for my opening remarks, sustainability of the governance of sustainability is high on our agenda in trying to promote long-term perspectives. Is as well. It's just, again, the concern that we have about the consultation that's going on is it being a bit legally prescriptive in a way that may not be entirely helpful. That's the question that we have, but we're certainly respect that the leadership that Europe has shown globally in setting a very clear and strong agenda for sustainability, and that's certainly an objective and a destination that we're supportive of. So, Richard, again, apologies for showing up late, but those will be some starting comments from me.
No apology necessary, but thank you for making that point about the need for coherence between what's going to be happening on reporting and what's happening on corporate governance, which is indeed why we're having this webinar. Now, I've got about 15 minutes to get in as many questions as possible, so I want to fire them at you. Short answers appreciated. Theo first. Of course, when you talk about any regulation at all, you have some companies that say, doesn't need it, just leave it to us. And then when you look at the sort of due diligence that Ericsson is undertaking, they look at their own supply chains and they get worried about being responsible for things several tiers away in their supply chains. What would you say to reassure those sorts of anxieties that we hear sometimes from companies?
Yes, no, that's of course a very good question, and I understand those concerns that the companies have, and that's exactly why we think that it's very important to base the legislation on existing frameworks that kind of account for the responsibility of companies and how that responsibility looks like in the entire value chain. So when you cause or contribute or you're directly linked to an impact, that decides the action that you need to take and also the responsibility as a company. So from our perspective, I think it's important to view this kind of legislation as an opportunity and not as a burden, because if it's done correctly, it will alleviate these concerns. Because currently, when we don't have a legislation, we have a reality where companies, where even though we have these international frameworks in place, there is uncertainty around how far reaching the responsibility is, what we actually expect from companies. If we have a clear and good effective legislation in place, then companies will have a legal certainty, and it will also make sure that other companies in your value chains take their responsibility. So I think we should really see this as an opportunity for companies to have a better and more coherent approach to due diligence and also liability and responsibility, rather than the current situation where there is uncertainty and it's more up to individual stakeholders to decide where the responsibility lies.
Thanks. And Steve, you've heard from George, and it represents a view that's out there, that they like the initiative, they like some of the proposals, but there's a caution around legislating in this area. And when I look, there was a study in Sustainability Journal last year that showed that still a majority of corporate governance codes in the different EU member states have a shareholder primacy focus to them. Do you think that legislation will be the way around that? And how do you respond when you hear that caution about moving to law?
Thank you, Richard. I noticed David put Watson's similar point as well in the threads. Hello, David. So I think the experience that David, yourself, Richard, and I had in the 90s, and I think George was part of that too, in the UK Company Law Review, with the then DTI, undertook a huge review of company law. I think we've been a little bit jaded by that. That put in various extended obligations on directors, like section 172, for example, and there were disclosure obligations as well. And we were quite, at the start of the century, we were quite optimistic that the 2005 then reform would actually lead to quite a lot of changes, because directors had new duties to consider the views of stakeholders. The reality is that board directors don't run companies with company law reports on their desk telling them what they can and can't do. The company secretary does have that, but the board is motivated by money, by making money. And I think that the most important thing that we can do to align the global economy with the delivery of the Paris Agreement and the Sustainable Development Goals, the 2030 Agenda, I see Herman Mulder commenting along these lines. I think the most important thing that we can do isn't open up a raft of potentially limitless litigation, but to actually close down these externalities and ensure they're embedded in the balance sheets of the business, the cash flows of the business, by fiscal measures, which of course is national, not commission, by market mechanisms like the emissions trading scheme. The price needs to be at least 3 times where it is today, even though it's at record levels. By setting out new standards, not just reporting standards like this, and also forward-looking ones, which is welcome that this is happening, but also standards and regulations around, if this activity, be it, I don't know, autos or agriculture, if this is happening, it needs to happen like this. That's how you harness the price motive, so that when boards make decisions about what makes money, they're actually putting our investor capital to work in the right places, and more sustainable businesses are rewarded with a lower cost of capital. Litigation and a raft of, if you like, legal cases isn't how you properly internalize the externalities. However, if there is fundamental breach, I think there does need to be recompense on stakeholders. There does need to be some ability for stakeholders to, for example, enforce the Universal Declaration of Human Rights. Theo again emphasized initiatives like the UN Guiding Principles on Business and UN Guiding Principles on Business and Human Rights, and their emphasis on remedy, and the OECD principles here, and their name and shame opportunity. So I think the problem with extending the litigation potential so that it is potentially limitless on supply chains of companies who have, in some cases, hundreds of thousands of suppliers is disproportionate. So I want to invoke that balanced and holistic perspective, Richard. I hope I've answered your question and George's point too.
I think you have. I think that John Rockey, the author of the UN Guiding Principles, said recently on this issue that corporate liability was only one of the methods of enforcement. He also talked about the important role of public authorities. I wonder, Caroline, what's your view on that question of enforcement? And do you mind if I put a second one into you, which is the PAC law in France also encourages companies to change their bylaws, their articles of association, to put purpose in there. Is that something you'd advocate at the EU level? So two questions to you, sorry.
No worries, thank you. I mean, yeah, enforcement, like, of course, the role of public authorities is extremely important, and we also believe at Oxfam, that corporate governance reforms are necessary, but we also believe that, tax reforms are also incredibly important. We also believe that there are a number of ways in which, in some ways, costs can be internalized, like those costs that today are not taken into account. But we also think that there are aspects that will be hard to actually, that are impossible to quantify in monetary terms, and that still require companies' attention. The results of human rights due diligence, and human rights impact that will be identified, and potential impacts as well, because this is also the focus of the due diligence exercise. You may have difficulties in putting that in numbers and adding that to the company's bottom line. So you need to think about over mechanisms to inform that, to make sure that those are actually responded to at the company's level. And to come back to your question on the PACT law, on loi PACT. Yes, indeed. So it actually has redefined corporate interest for all companies. Literally, it says to take into account societal and environmental considerations, but also companies can decide to move further and have a stated purpose that is called a mission, where they will have something that is that will be phrased as more like a positive contribution to society. Our view on that is that I think we have enough work to do to actually address the negative impacts that are now created by companies' activity without creating the possibility to dig into the possibility to have positive outcomes. So I think our view is that we need to focus on addressing those negative impacts before moving on to something that is phrased and packaged as a positive contribution. I mean, of course, companies can have positive contributions, but today we are discussing the ways in which we need to address all of those negative impacts, and that is what we think should be the heart of the matter at the moment. And the PAC law was a not sufficient effort because it's not clear. Actually, it actually has created legal uncertainty for companies. I think companies have also said that it's not clear for them how this is supposed to be informed. So that's why we think that there should be more coherence into all of that.
Thanks. So learning from that, I think, can definitely be part of the EU drafting. George, you've already said you think the initiatives in this area are important. It's going to be part of your new work plan. But I think there will be people wondering that companies have been talking about sustainability. They've been talking about the SDGs, making pledges, making commitments now over a number of years. And yet only a third of sustainability reports are signed off by the board and board members themselves in a survey. This is an INSEAD survey with Nazar. say that they have the necessary expertise on sustainability themselves and within their board. So how can there be this distinction between what companies are saying about the importance of sustainability and how that's reflected at the board level?
You know, I think it's a cliche to say that this is all a journey, but it is. I think that perhaps in many companies there remains a degree of whether it's suspicion or just lack of conviction that some of these issues are as important to their governance as others. And I think I think law can change things, whether it's through disclosure requirements or other activities. And I think the voice of investors, can and should be part of the message as well, that this is not, this is not an optional item. This is something you have to do. You need to do it in your own way, in a way that suits your own business and reflects the risks that are most material to this particular company, given its sector, given its state of development and the like, but it still is something that has to get done. And so I think that we want to encourage this, Richard, but I also believe that, how you encourage it and to do this in a way that will actually produce the most effective results is, that's the big question underway. And will hardwiring some of these activities into hard law bring this result about? Perhaps, but I think there's also the possibility it could create some unintended consequences as well. So I think part of the answer is just continuing to keep up the pressure. I hope and believe that as we have more sustainability data to develop evidence, evidence trails that start to link sustainability issues more clearly to financial performance or other specific outcomes that boards and investors are aware of, that this momentum will continue to build. But it is a journey. I think we're making progress, and we shouldn't be content at all. But there are obstacles, and I think it's just part of it is just I think part of this is cultural. And I also like the idea that Steve mentioned, and I think David must have mentioned this before, David Pitt Watson, about the more we can link these sustainability issues, not only in a sustainability report that's signed off by the board, but the more we can find linkages into the accounts, that's where I think it really is going to have a lot of traction. So I think that we need to focus more on those activities too.
George, thank you for your comments. Thank you to all our panelists. I think that point about reflecting in the finances has come out strongly in terms of this morning's panel, but we've also heard about the need on human rights due diligence, that some of those things might not be monetarily reflected. We've heard that there's a need for hard law in some areas, but not all. We've heard about the corporate support that there is for this and from investors. And we've tried to cover the full range of key issues in the Commission's consultation on board oversight and composition, on remuneration board and executives, the need to integrate strategy, sustainability strategy into business strategy, to set targets and to report on them, and to introduce incentives, remuneration that reflect them. I hope that we've done justice to all of that. We've still got two very important keynote speakers to come. So thank you again to all of our panelists, and I'm delighted to hand back to Mardi.
Thank you, Richard. Super panel discussion. And thanks to all of us, everyone that's been joining in the chat. There's a really great conversation and lots of really good information there. So have a scroll through if you haven't already. So we'll now hear from our closing keynotes who'll provide concluding remarks, leading us to consider what the future might look like. First, let me give the floor to Alberto Carrero Pineda from the Science Based Target Initiative to tell us more about the initiative from its inception to the current state of play, as well as the role science-based targets can play to improve corporate strategies, governance, and accountability. Alberto, the floor is yours.
Thanks, Mardi. Hi, everyone. I hope you can hear me well. Well, first of all, I would like to thank you for the invitation to speak today, and to all of you for your generous time. Yeah, I think it's quite an interesting discussion, and I think the work that we've done in the Science Based Targets Initiative is a good example of how some of these things can be materialized And so I would like to start by providing a very high-level overview of the work that we're doing in the Science-Based Targets Initiative, and yeah, how this connects to some discussions that have happened this morning. If you go to the next slide, please. So first of all, for those of you who are not familiar with the Science-Based Targets Initiative, the initiative is a collaboration between 4 organizations, CDP, UN Global Compact, the World Resources Institute, and WWF. And we work with a large coalition of organizations, including the Women Business Coalition, and many others that are helping us amplify and drive the adoption of science-based targets, including a growing community of investors. And our goal is really to make science the main benchmark to set and implement corporate climate targets. View the next slide, please. And briefly, science-based targets are basically GHG emission reduction targets that are consistent with the ambition that, according to science, is needed to meet the goals set in the Paris Agreement. And in a way, it's an exercise of translation of long-term goals that are embedded in the Paris Agreement, that are defined at the global level, and that are expressed as temperature metrics, well below 2 degrees, 1.5 degrees, into actual and implementable targets that can be internalized at the company level, and that can drive the action and the accountability that is needed for companies to align to the Paris goals. If you go to the next slide, please. Science-based targets are, by definition, aligned to the long-term goal that we have, which is, of course, to limit warming to 1.5 degrees, well below 2 degrees, but also to reach net zero emissions by mid-century. But they are expressed in a time frame that actually maximizes accountability, because we are talking about basically short to mid-term targets, which are aligned to this long-term vision, but are trying to make sure that these targets lead to short-term action. If you go to the next slide. And science-based targets are forward-looking. They are aligned with the planetary boundaries and society long-term goals, in this case, for climate, although there's also development of science-based targets for other planetary boundaries. In the criteria that companies adhere to, we make sure that companies focus on the most relevant impacts in their value chain, including scope 3 emissions. And today, out of the nearly 600 approved targets that we have, 94% of them have scope 3 targets. And as I mentioned, they are formulated in a time frame that makes sure that there's accountability. Most of the targets that have been approved have a 2030 target year. Next slide, please. And this is more or less the process that companies follow when they set science-based targets. They start by committing to set a science-based target. They have 24 months to go through the process of modeling, and then getting their targets validated. All targets are validated according to a set of criteria to make sure that they fulfill this criteria, and to ensure that targets are meaningful, cover the most relevant sources of emissions, and are ambitious in line with science. Once the targets are approved, then companies normally announce the targets, and then they start, of course, the implementation phase. Companies are expected to track and disclose progress against their targets, and to review their targets at least every 5 years to reflect on any new conditions in the company or in the science, for instance, that inform the adoption of the targets. And so this is the process and what companies have committed to. Next slide, please. Today we have nearly 1,200 companies that are setting science-based targets or in the process of modeling their targets, nearly 600 approved targets, and the majority of targets are in line with 1.5 degrees. Next slide. And as you can see here, we have the largest share of adoption of science-based targets in Europe. We have over 600 companies that are in the process or that have already approved targets, and they're aligned, of course, to the Paris goals, but also to the ambition to reach climate neutrality adopted at the EU level. And I would say one thing to consider is, of course, the regulatory framework has a lot to do with the level of adoption of science-based targets. And I think the fact that we have the framework that we have in Europe incentivizes companies to adopt this type of targets. But there's also many other mechanisms that are important and that are needed beyond the regulatory framework. As I mentioned before, we have a growing number of investors that are asking companies to set science-based targets and to commit to reach net zero emissions by mid-century. We have a growing number of companies also making sure and asking their suppliers to set science-based targets. And this is also a key component and something that we believe is critical to accelerate the adoption of science-based targets and to institutionalize the practice. And we have, of course, also a growing number of actors and initiatives that are pushing towards the same goal. And all of these are necessary ingredients to really create an enabling environment to make science-based targets, and I would say the adoption of sustainability targets and strategies that are in line with planetary boundaries and our goals, basically a common practice. So we think this is definitely inspiring and a good signal of the progress that can be made, but also that much more progress is needed. And we hope that the initiative being discussed today can help trigger that progress. Thank you.
Thank you, Alberto. That was fantastic. Now, last but certainly not least, let me turn to Ms. Heidi Höckler, Vice President of the European Parliament. Among her various roles, she chairs the Responsible Business Conduct Working Group and has been very active in the European Parliament on corporate governance for quite a number of years, a real champion and advocate for this space. So I'm really delighted that we can hear the European Parliament's views and expectations on the various policy initiatives on sustainable corporate governance, reporting and due diligence. Heidi, the floor is yours.
Good morning. Do you hear me? Do you see me?
Yes, we do. Thank you.
Yes, thank you. Yes, thank you so much, Mardi. It's very inspiring to hear your voices now at a moment when the EU is indeed trying to integrate the various ideas and proposals and views on sustainable corporate governance and due diligence and sustainability reporting. I think it's remarkable that it's 20 years ago since the UN Global Compact was calling and inviting companies to be part of global solutions rather than creating problems. And it's 10 years since UN Guiding Principles, so we're also going to the second decade. The European Parliament is very loud and very clear that corporate governance has a key role to play in delivering the EU's commitments to implement the UN SDGs and the Paris Agreement. We believe that by setting out a full implementation of the European Green Deal, the Commission has raised very much their ambitions and affirmed that Europe cannot just follow global trends. We believe that Europe must lead the transition to a healthy planet. So I think at best what we are trying to co-create here between different institutions and different stakeholders is a good chance that we'll have another Brussels moment, because whether we remember that always or not, the EU is still the world's biggest internal market, and its attraction to do business is very, very big. So to do sustainable business in the EU internal market would also be extremely powerful. So I fully agree with those who have said that it's the duty of the lawmakers and politicians to internalize the externalities, such as climate change. But after the politicians are doing their best to achieve that, it really is the duty of companies also to contribute and to live within those frameworks that politicians put in place. The particular topic today and at this time is that our actions and our legislation must be consistent. So it's vital that the EU will set concrete obligations and incentives to act and not only to report information. I think Teo Jekyll put it very well. He said that disclosure is not enough. It's in a way the last step that should follow from a thorough due diligence. And that is indeed why we need a combination of different instruments here. So the Parliament is calling for new legislation on due diligence and directors' duties, apart from the ongoing review of the non-financial reporting directive. I listened to Professor Johnston pointing out that traditional company law was not written with sustainability in mind. Both the law as well as the company mindset has focused on shareholder value. Now the tide has turned and companies see that they need to incorporate sustainability into their processes and decision making. But traditional company law may even be a roadblock, a hindrance. Therefore, I believe that the EU must rethink and revise the company law. The purpose of all these initiatives, the NFRD revision, the sustainable corporate governance and due diligence initiatives, is to encourage, to enable and to effectuate this paradigm shift. Commissioner Reynders told us that the legislative proposals will reinforce each other. And I'm very pleased to see that the various parts of the European Commission are very actively interacting and talking to one another so that we get a consistent framework together. In practice, this means that, for instance, we have to be able to adapt the new revised non-financial reporting directive to what comes out of the due diligence legislation, because indeed what needs to be reported, where the company's accountabilities lie, should be defined in the due diligence legislation. So all these proposals have a shared goal. It's not just that we need to implement sustainability into the European company law. The goal is to make sustainability an essential part of the corporate culture. And we know very well that best companies have already incorporated sustainability in all what they're doing. For these companies, acting responsibly and sustainably is the only way to act. But these companies are still few and far between. Many corporate directors have told me that already now they are expected to be responsible and sustainable, but in the future these expectations will become legal obligations. So in corporate language, the company's environmental, social and governance ESG performance is crucial in building trust with the shareholders, customers, investors and stakeholders. And I have seen that company boards have the capacity and possibility to be in the key position to build this trust. The board and its audit committees can show if the company's ESG actions are effective or mere greenwashing. But companies cannot do it on their own, not yet, because companies and company boards do not yet have a common language. I've been delighted to hear that actually we should be able to define a common language. We should speak sustainability. We need legislation and standardization so that companies can measure, compare and communicate their sustainability performance. And only then the CEO and the board can confidently tell to the investors and the whole world that my company is not just improving, it's improving faster than its competitors. So I believe that the EU non-financial reporting standards could become the globally recognized best practice, the lingua franca, the common language of sustainability. I listened to Mr. Jekyll again to explain the role of law very clearly. He said, law brings legal certainty and ensures that also companies in a company's supply chain take care of their obligation. So how company performs is not a coincidence. It's a result of deliberate strategy choices. The sustainability strategy is deeply connected with the overall business strategy. And therefore, to conclude, my message to the European Commission is that make sure that the metrics and the key performance indicators for the ESG are as strong and clear as the key performance indicators for the financial performance. So at the same time, in order to thrive in the sustainable economy, my message to all companies is to make sure that you have a robust future-fit sustainability strategy, and that the directors, CEOs, CFOs, the company board and the audit committee have fully embraced that it is a part of their core responsibilities to lead and oversee not just financial, but also the sustainability performance. Because, dear friends, in the future, this cannot be separated from one another. Thank you.
Thank you, Heidi. Not separating from one another, I think, is a really nice way, fully integrated is a really nice way for us to end today's session. So thank you to all of our speakers for your insights. Thank you for everyone who's participated in the chat. I've learned a lot from the chat as well. It's been brilliant. We've hope we've opened you up to a few new perspectives and had a different look at corporate governance today. I'd also like to thank Frank Bold for co-organising this event with us. We will circulate a summary of the discussions by email and respond to any remaining questions. As this was broadcast on LinkedIn, you can always go back to the recording on there and share it to your colleagues and friends later. I wish you a great rest of the day, and we look forward to more engaging discussions with you in the future. Thank you, everyone.